Hello everyone, this is Billion Babai. So one way of identifying good companies is to see those companies which are for special reasons trading below their par. So if you take the list of companies which are trading below par in National Stock Exchange, there are about 100 odd companies are there. Out of them, the top one is 3i Infotech. It's caught my attention because it was promoted by ICICI Bank to support its own back-end operations, and later on it has grown by acquiring quality certifications, international stature, and it is now the fourth largest, say, multi-vertical infotech company in India, right? So that means it's a really good company. Now let us see what is the price of the company it is quoting now. The lowest was about 3.75 in this year. Highest was about 7.15 in this year, the face value being 10 rupees. And today the price is 5 rupee 45 paisa. So it has gone down. It is below par. Now, what has exactly happened? The company has been under CDR, that means a corporate debt restructuring arrangement with the Standard Chartered Bank and DBS Bank. And it has to work out some of the FCCBs, long-term loans, foreign currency borrowings, and has to liquidate them. So these are the twin issues, that is paying off some loans and then corporate debt restructuring with the company, with the banks in India, that has actually made the share fall foul of the market. Now, on December 12, 2016, the company has issued $42,441,750 2.5% convertible bonds due 2025, the new bonds, in exchange for the existing bonds, to the extent that such exchange offer was accepted by the holders of the existing bonds. This was an exchange offer in December 12, 2016. On January 2, 2017, it has allotted 10,82,89,063, that is 10 crore 82 lakhs shares, equity shares of a face value of 10 rupee each, and 18 crore 95 lakhs 0.10% cumulative non-convertible redeemable preference shares at the face value of 5 rupees each at par on a preferential basis to Standard Chartered Bank upon its accession to the supplemental MRA in December 20, 2016. So it is trying to get out of a bind, a financial bind it finds itself in. Now what exactly is the financial bind and whether it is worth our view? Let us see. It is a global information technology company. It provides technology solutions to 1,500 customers in more than 50 countries across 5 continents, spanning a range of verticals. It provides the software products, IT services, business process outsourcing for a variety of industry verticals like insurance, banking, capital market, mutual fund, asset management, wealth management, government, manufacturing and retail. Okay, so now what exactly was the price? The price it was 30th May, it is 9 rupees, has fallen down to 2.9 in 29th May, and now it is 5 rupee 45 paisa. So market cap accordingly has varied. Now the net worth of 2015 was minus. It has gone into negative net worth. So that must be the reason for MDR. The current asset turnover was minus 6.5%, and actually if you see the ratios, you find that the current assets are being financed more. Actually the current liabilities are being used for long-term uses. That means current assets are less than current liabilities. That's 0.7 is the ratio. That means 0.3%. Actually it should be 1.33. So 0.3%. These of the current liabilities are being used for long-term purposes. Okay, maybe for say tax purposes or whatever. Okay, the earning per share is minus 18 as on 2015. It was minus 8 in 2014 and minus 6 in 2013. Its net worth has become negative. Entire net worth has been written off, completely gone. So total assets are 3723 and non-current assets is 3051 and current assets only 6.2. Because it's an IT company, current assets will not be much. But still, even then, current liabilities are 922 while current assets are 652. So 300, something around 270 270 crores of the current liabilities are being used for long-term purposes, not for short-term purposes. That means they are trading, over trading on their current liabilities. Now in 14-15, the reserves and surplus declined by minus 1053, and to 13-14, reserves and supplies declined by minus 4191. So these are the main things. And then let's see the ratios. The debtor turnover ratio was 3.75 in 2013, has come down to 0.70. So it indicates there is a problem. It's 0.54 in 2014, 0.70 in 2015. It indicates a problem in debtor side. That means they are unable to recover the debtors, and then because of that their company is becoming very, very poor. And the fixed asset turnover 0.10 or 0.13, it was on the same plan as 2013 and 2015. The current asset turnover has fallen from 1.46 to 0.61. This current asset turnover attached to the debtor turnover indicates that their day-to-day functioning, the way of financial functioning in this particular company has been poor. Because of that, they had to go for. And then what are the return ratios? The operating profit margin 2014 is minus 128%, 2013 minus 103%, 2015 minus 85%. That means it's slightly reducing from 14 to 15. And return on assets was minus 6.3%, minus 9.8%, and minus 28%. So return on assets has been very, very horrible. Return on capital employed, return on equity was minus 24% in 13 and minus 73% in 14. So absolutely no return has been given to the and the current ratio is 0.71, as I told you, 0.26 in 2013. So it has to strengthen its day-to-day working and recovery of the current liabilities, current assets. And market cap by EBITDA is 192.42. Okay, so EBITDA is very, very low. Okay, and trading volumes are also very high. Now the promoter shareholding has come down from 6.82% to 4.77% because of FCCBs and sacrifice made under CDR, and then shares have been issued to the banks, SD, Standard Chartered Bank and DBS Bank under CDR scheme. The company has issued 14 lakh equity shares and 1 crore 16 lakh equity shares to Standard Chartered Bank and DBS Bank. So because of that, promoter shareholding has fallen from 6.8% to 4.77%. Because the promoter is ICICI Bank, after it makes no difference to them, because none of the other banks will be willing to take over the management. There is no fear of takeover of management in this case. So they are very generous in handing over the thing. So now what is the position for us? What exactly what can do with it? As I say it, now that the CDR is over, and now that they have already completed their activity of adjusting all the loans and the problems are behind them, they have only ways they can go up only. So it is a good opportunity. It is a good company. It's a very strong company. It's a good parentage. And though it has temporary problems, if it is able to solve its current assets problem, its debtor collection problem, then obviously there will be no problem for the company to zoom up. And it is available for 5 rupees. A 10 rupee share is available for 5 rupees. It's a good opportunity for all of you to purchase. Just examine this share. Thank you.